on this edition of the Money Show, we are going to be talking about the action that a lot of mutual funds have had to take because of their exposure to Vodafone Idea. As you know, when you give your money to a mutual fund, they in turn invest that money across various securities, debt side as well as equity side, depending on the kind of mutual fund that you are supposed to be investing in, whether it's debt or equity. Hence, a Vodafone Idea, when the Supreme Court delivered its AGR verdict, it saw its share price tank, its debt securities as well were hit, and concomitantly, the mutual funds that had exposure to various securities of Vodafone Idea as well saw its net asset value, or the NAV, fall. One such is Franklin Templeton. In fact, it marked down its Vodafone Idea exposure. But it's not just Franklin Templeton. Other mutual funds as well have seen a drop in the value of their holdings. Those should come up for you on your screens in just a bit. There's the UTI Mutual Fund, the Nippon India Mutual Fund, Aditya Birla Sun Life. All of these fund houses do have certain funds of theirs that have an exposure to Vodafone Idea. And that list, those details should come for you in just a bit. Now, the question is that if any of you guys out there watching do hold funds in any of these AMCs, you may be wondering, what should you do? Should you consider exiting the fund? Should you stay put? And also, the other question that this entire episode begets is that how closely then should I open a fund's fact sheet and check what are this fund's holdings? We'll be discussing that and more with Kalpesh Ashar of Full Circle Consultants. Kalpesh, thanks so much for joining us right here in our studios. So Kalpesh, you know, as we know, there's this entire Vodafone Idea issue that has culminated, which again, and I suppose it's more or less of a reminder as well. We have seen this happen with DHFL. We've seen it happen with IL&FS, Yes Bank as well, in fact, after the share prices crashed. Yeah. And now Vodafone Idea. What's usually the first impact in NAVs and mutual fund values?
So, you know, this is not the first and neither have we seen the last of it.
Yeah,
and unfortunately, and like you rightly said that, the debt-based investors are taking a knock on their head, you know, at repeated intervals. And that's not a very good thing to happen. But I think we are in a capital market. There are always the emotional and the financial factors which, you know, ultimately add to this. Now let's understand the crux of this problem, that there's Vodafone and Idea have been facing a lot of problems in the recent past, and the equity share investors and the mutual fund holders also are very well aware of it. Now what happens here is that because they've seen the problem occurring time and again, they have lost confidence on a regular basis. And that has reflected that the share prices have dropped, and there have been small type of redemptions happening from these funds of the knowledgeable investors who knew that there's a holding of Vodafone Idea in certain funds. And that is spread across the category. Credit risk and ultra short and all those type of funds have these holdings. Now that was always happening. It was on the anvil till the Supreme Court passed the impending AGR liability clause, and which it said that now it's almost non-reversible. That's when this ultimate inevitable negative news caught up, and as a result of that, we saw that the Franklin Templeton, which had one of the most major holdings in this Vodafone Idea, almost marked down its complete holding to zero. Now, when that happened, it surely sends a lot of NAVs tumbling down. Not only of Franklin Templeton, obviously, which had marked down it to zero, but the other fund houses also were looking at it closely, but they didn't mark it down to zero. They adjusted it to the MTM, the mark to market, or varying degrees of percentages. So the complete Franklin Templeton holding was brought down to zero, and thus I think what has happened here is that there would be no further losses to the existing investors of the Franklin Templeton fund, in which these 6 funds were affected. Now, the total exposure of all mutual funds in this Franklin, including Franklin, Nippon, and Birla, and so on and so forth, was almost, if you were to say, it's almost 3,300 crore. And of it, Franklin Templeton held the most paper of Vodafone Idea. And when we say paper, we should not forget that there are different types of paper which are held by different schemes. So this is the one which we are talking in the immediate basis. Now, the Franklin Templeton, once the markdown happened, the NAVs on the next day proportionately fell by almost 4 to 7%. Now, when we say 4 to 7%, it practically removes 6 to almost, I would say, 9 months of an yearly return of a mutual fund, debt-based mutual fund. So that's a big, big knock to take. But by doing this, what Franklin Templeton has ensured that there are no further losses which should accrue to the existing investors. And if there is a possibility in the coming week, or because it's you would say a too big to fail type of a concept for Vodafone Idea, and if Supreme Court were to give a positive response to the AGR or something like that, there is always a chance that, like the mark down happens, there could be a mark up. So I would genuinely, feel that although the damage has been done for now, the existing investors who are in this, at least the Franklin Templeton schemes, should stay put, should stay invested, because the damage has been done and there's nothing further which you could happen to you. So that's about the Franklin Templeton Fund. And the other AMCs, which we just spoke about, the Nippon and the Birla and most importantly UTI, even their NAVs have cracked by almost 0.5 up to 2% or 3%, 4%. And in one of the funds, the UTI, I think if I'm not mistaken, it's the credit risk fund, it's gone down by 10%. And I would attribute it to the high concentration of paper which it had singularly of this Vodafone Idea. So that's a concentration risk which is showing up now.
Okay, so for Franklin Templeton, I suppose the good thing that the fund has done has already marked it down to zero. So now, if there's any sort of positive news flow, like if the government says that, okay, listen, Vodafone Idea can stagger the payment for, let's say, 8 years or 10 years, then there is a chance it may mark up, and that would only mean that the mutual fund holders would stand to benefit. Because the worst has already been taken.
But to what extent, we do not know.
Okay.
So it all depends on the hearing and how the developments take place. But I think the damage has been done.
So for Franklin Templeton mutual fund unit holders, just stay put right now.
Absolutely.
Okay, all right. What about the other guys who have not yet marked it down to zero? I mean, their exposure was not as much as Franklin Templeton. So what about the other guys, and Aditya Birla or UTI, like you mentioned specifically, like we saw the credit risk fund, right? 10% gone in the NAV. What should they do then? I mean, should they continue staying patient with it? I mean, what will happen to their fund?
See, Mubina, what happens is that when you get into a debt fund, it's, I think, a case of understanding for everybody that people should not equate it with FDs or savings bank account type of a thing, Although we know that it's far more safer than an equity fund and all those things, we very well know that, but people should not forget that there's always a risk return type of an equation here. So once you get into a debt fund, you should also understand there is some element of risk which is involved, plus also understand that there is an exit load. And there is also a tax implication. So in debt funds, if you were to exit, say for example, you just invested 6 months back or a year back, and this news has come upon you. I'm talking about the other AMC case which is there. So those people, if they decide to make an exit here, what they should be doing is even looking at the complete picture of their portfolio, that if they were to exit right now, first of all, they're taking the hit of the mark-to-market losses. Secondly, there would be an applicable exit load because they are not ultra short. If there is a credit risk, there could be an applicable exit load. An obvious thing is that if there is even a marginal capital gain, the tax implication would come because you're coming out before the 3-year period.
That's a period, yeah.
That's what is the underlying thing. So people should look at it on an individual basis rather than an universal call of, stay put or, redeem and all those things. So look at your existing profile and then take a call. Now, for example, if people have been invested in those funds, hypothetically, for say 5-6 years, and they've reaped a good amount of profit from that, there's no harm in coming out.
Okay.
Because you don't know the future. Like if there's a positive news, the Supreme Court might just negate it, and you might be in for more trouble. So because they have not written down the complete value of their holdings, unlike Franklin Templeton has, there could be more trouble in store for them. Yeah. So the personal holding also needs to be seen, and then you take a personal individual call on that.
So basically, two key factors. One is the exit load, which would be applicable,
yeah.
like for example, in a credit risk fund. And the second is taxation. Like Kalpesh mentioned, for debt funds, the holding period has to be beyond 3 years, and then you do not
To
have to pay
benefit
any
from
tax.
the 20% with
The
indexation.
20%
point.
slab, exactly,
Yeah,
yes.
yeah.
But if it's under, then it'll not be a very tax efficient thing to
Yeah.
do. And yeah, of course, if you're holding it for, let's say, 4 years, 5 years, and you've reaped a good amount of profit, then it makes sense that, okay, maybe you could consider exiting, because
Absolutely.
these guys, the UTIs, the ABSLs, they have not written it down to zero. Franklin Templeton has. So fair point. Which now, like I said, begets the question. I don't want to be in this position, right, where I have to make a decision that, oh, okay, do I have to exit this fund? What's my tax liability?
Absolutely.
I mean, many a times individuals invest in mutual funds because they want that peace of mind. They don't have the knowledge, so I'm giving it to an expert out there that, look, you know what, I don't know much about stock markets. I'm busy, treating patients or teaching students or doing what I'm doing,
Absolutely.
right? So in order to not have such a situation, what should they do? I mean, should they actually check every mutual fund, check the fact sheets which are released every month and see, okay, which companies are there, and read about the news flow? Because, I mean, on an average, individuals hold 5 to 6 mutual funds. So it can become a logistical nightmare to check fact sheets every month for 5 to 6 funds.
Yeah, in fact, more than that.
More
So people
than
have
that, yeah.
10 to 12 schemes in their
Exactly,
portfolio. So that's
yes.
a problem.
Yeah.
Anyway, coming back to this problem, first and foremost, what I would like to tell everyone is that in debt funds, do not look at generating excess returns or creating an alpha when you are investing in a debt fund. A debt fund is primarily a very, I would say, a conservative investment, and you do not go there for excitement. The excitement lies in the equity portfolio. Your debt fund is practically to give you a little bit tax efficient, better returns with an element of risk, more than a bank FD. And if you are investing in a liquid fund or an ultra short duration fund, again with an element of risk over a savings or a current account. So understand that you are not into debt funds for creating great returns with a very minimal risk. No, that's a myth. Secondly, when you are investing in a debt fund, the mindset should be conservative, and you should also try to figure out, if you're a aware investor, what is the mindset of the fund manager and the fund house, the AMC, as overall when approaching debt funds. So that is the second point. The third most important point, Mubina, here is, what has happened with this particular thing is, like we saw in the UTI case, the concentration risk. That is immense. And when we check a fact sheet, it is, I think, a simple arithmetic that if a fund house, if a fund scheme is also holding too much percentage of a particular paper or a company or something, I think that's a little bit of a red signal, and that could be very alarming if something wrong happens with that particular fund. So concentration risk is to be seen, and always, like in an equity fund, a diversified basket in debt fund scheme also is much better. So that is the third point. And the fourth point is obviously credit ratings. So the better the credit ratings, it is safer. You will generate lesser returns, but your risk level also will minimize. We have seen accidents happen in AA, AAA also. Now that's an unfortunate part. But I think you are cutting down a lot of risk by investing only in AAA rated portfolios or schemes and so on and so forth. And the last thing is that, being a financial planner, I cannot help but say that all the investments which you make, be it debt, equity, in this particular case, debt, should be aligned with your financial goals. Because if that is the case, you know what is the period you're holding it for, what is the purpose for it, and you will be more focused and aligned for it. So the debt funds also is a part and parcel of your complete fixed income portfolio. So if you have a fixed income portfolio, everything cannot be in debt funds. You need some portion of bank FDs or corporate FDs, so on and so forth. So again, we are not concentrating in our schemes also. So that's what I think a normal investor should do. And if you are unable to go through the fact sheets and understand the ratings, then better consult your financial advisor or planner, and he'll help you out.
Okay, well, folks, there you have it. Words of advice coming in from Kalpesh Ashar on how you can deal with this newest issue that's cropping up that's hurting your NAVs and how you could go about it. All right, well, on that note, I'd like to kickstart our Ask the Money Show segment. I'm going to leave the phone lines open for you, our viewers. If you have any questions or queries, you could call in and Mr. Kalpesh Ashar will be here to answer them. 24990300 is the phone number that you could call in on right now. But in the meanwhile, I am going to take on board some queries that we've received via email. Our very first question is coming in from Mr. Chandrapa BV. He writes into us saying that I'm 46 and have been investing via SIP for the last 3 years. He wants to continue investing for at least the next 10 years, so that's good. His time horizon is long. His risk factor is moderately high. So he's got a lot of funds, mind you. He's got like around 4,000 rupees in the Reliance small cap, 2,000 rupees in L&T and Axis's mid cap fund, another 5 grand in SBI blue chip, then 2,000 in Mirae Asset Emerging, 5,000 in Motilal Focus 35, 3,000 in another small cap fund from ABSL, 3,000 in Franklin Focused Equity, and then 2,000 in a tax fund, that's the AB Sun Life tax fund, and 2,000 in ICICI blue chip fund. So I think, Kalpesh, largely I see only, I think, 2 or 3 blue chip funds. Most of them seem to be either mid cap and small cap funds. Yes, he is a long-term investor. He's, by the way, 46 already. It's a good chunk of money he's put in an SIP. But do you think this fund composition is good to go to?
No, so I would say 75% it's fine.
Okay.
But yet, I would still, stick my neck out and say that although he calls himself, a risk taker and his portfolio is comprising of many mid and small cap funds, my advice would be that, he can cut down on 2 or 3 of them because they're too repetitive in the portfolio, and he can shift to multi-cap funds because that is where he'll get a good array of large, mid and small type of categories. And the number of schemes which he has in his portfolio, I think he needs surely to trim down because it just adds to duplication and a lot of paperwork. And I think even reduces the average returns over a period of time. So stick to 5 to 6 proper schemes. You could have around a couple of large caps. You could have a couple of multi caps and couple of mid and small caps. That would do the job for you. And last thing is that although you have a long-term horizon, I would still, as a financial planner, advise that have proper financial goals. So once you have a goal, it could be your retirement or it could be your children's higher education, whatever it is, once you give a name to it and once you start, focusing on it and writing it down, then automatically you are more disciplined. I think just having a portfolio and saying that you're invested for the long term is fine. But I think the real element of, disciplined approach would come if you start naming your goals.
Well, yeah, and yes, our viewer here has not mentioned what he wants to save for, what he's essentially investing his money for. He's just given his funds. Of course, one could assume that since he wants to invest for another 10 years, he'll be 56 by then. So it could be for retirement, but it's always best to mention your goals as well. Okay. Let's take on board a question that we are getting in right now from Gopinath. He's calling us on the phone line from Chennai. Hi, Gopinath. Good evening. What's your query?
Good evening, madam.
Yes, go ahead with your
Finally,
query,
I
sir.
got a call receiving confirmation. Thanks, madam. Madam, I have a small query, madam, because already I invested in so many mutual fund,
Okay.
nearly 10 fund.
Okay.
This is SIP only I'm invested. 1 year completed. I need special advice, madam, whether this is a good fund or
Sure,
whether I
sure. So
continue
go
or
ahead.
not.
Tell us which funds are you doing an SIP?
Axis Blue Chip I invested, madam.
Okay.
And Mirae Asset India Equity and Sundaram Large and Mid.
Okay.
And UTI Equity Fund and the Investo Contra and the HDFC Midcap Opportunity and Reliance Large Cap and the Aditya Birla Genext Fund and Tata Equity Fund and the Canada Equity Fund, madam. This is my invested fund, madam. 1,000 rupees I invested monthly, madam. 1 year completed.
Okay.
Just now is some problem going on in Vodafone area.
Yes.
Whether I continue the SIP, madam, it's a good fund to invest.
So you have, I think, 10 funds is what roughly I've noted down. Is that correct? And
Yes,
1,000 rupees in each. Okay, so
Yes, madam.
just for your benefit, I'll just sort of revise them again. There's Axis Blue Chip, Mirae Asset, Sundaram Large and Mid Cap, UTI Equity, Invesco Equity, HDFC Mid Cap, Reliance Large Cap, ABSL Next, Tata Equity, and Canara. Sorry, could you repeat the last one again, Gopinath? Is it Canara?
Canara Emerging.
Okay. Canara Robeco Emerging Equity. All right. So 1,000 rupees each. He's invested it only in the last 1 year. And I understand why he may be worried, because obviously in the last 1 year, the
Absolutely.
markets have
Markets
not
have not
been
done anything.
in the best shape. So yeah, also, Gopinath ji, if I could ask you, I'm assuming you have a long-term time horizon of at least 7 to 8 years. Is that right? Okay, I think we've lost him, but let's assume that he can invest, because, I mean, you shouldn't be in mutual funds, frankly, if you don't have that at least 6 to 7 year time horizon. So yeah, what do you make of the composition? Too many funds, too concentrated?
Yeah, absolutely. It's too many funds.
Okay.
And 10 schemes, if you've noted down,
Yeah.
for an SIP of 1,000 rupees, I think he's just into too many, I think, paperwork.
Yeah.
And simply he can limit himself to Axis Blue Chip and the Reliance Large Cap, which is now the Nippon India Large Cap. For the large cap exposure, in the mid cap section, he has the HDFC mid cap opportunity, which is a good fund. He can go in for the Kotak Emerging Equity. If he doesn't have that, that's a good one. And multi-cap, obviously, the Canara Robeco is a good scheme which he's already into. So 5 schemes should do the job for him. And if he has any concerns on Vodafone, I think that's the debt part of it. These are all equity funds he's talking about.
Yes, that's
so
right.
you should not be too concerned on that aspect. And like what you rightly said, Mubina, you answered the question that his horizon has to be, whatever the amount does not matter, his horizon has to be anything beyond 5 to 7 years. Then only he will see the real returns generating from an equity mutual fund.
Okay, so keep it simple. You need not keep so many funds. You may just add on a Kotak Emerging Equity Fund, but otherwise Axis Blue Chip, the Nippon India, basically the Reliance Large Cap, HDFC Mid Cap, Canara Robeco are great. You could consider, trimming down your fund a little, your portfolio a little, or it'll just become too much of a nightmare to keep track of. And I hopefully that'll do the trick for you. It'll help you, achieve your financial goals. I hope, Gopinath, this has helped you with your query. All right, we have Indrajit calling in right now on the phone line from Ludhiana. Indrajit, good evening. What's your question?
No, actually, I wanted to know about this debt mutual fund fiasco that has occurred after this AGR Supreme Court review.
Yes.
So, what about the mutual funds in the ultra short-term funds or the liquid short-term funds that are having exposure even to Bharti Telecommunications?
Bharti Airtel, yes. Okay. Okay, all right. So the fiasco, as he calls it, and you could call it that, because this is not the first time that something like this has happened. We've seen it happen with DHFL, etc. So if you could just sort of revisit that topic with him. And also, what does it mean for an ultra short-term fund and a liquid fund, like we were saying, right?
Absolutely,
Within the debt fund umbrella, there are different duration funds as well. So what happens to ultra short-term and liquid funds? If you could explain that to Indrajit.
So basically, if you're worried about Vodafone Idea versus Bharti, I think that's his more alarming concern.
Yeah.
What he's asking. Vodafone Idea, I think I'm not a stock expert or anything on the company part, but whatever you get to know is that Vodafone Idea has been facing a lot of problems in its operational thing, and it's always been on the downside, as we see even operationally, and all the figures show about it. That in fact, there was a statement that it had asked for help from the government to shore its operations up, and they were in a lot of problems. Now, when the AGR ruling came from the Supreme Court, all the telecom companies were asked to, amend their books and come up with the amounts which they had to pay for the adjusted gross revenue, that is the AGR. I think Vodafone, because of its downhill or the negative headwinds which it was facing, could not take it up, and I think that took a big toll on its share prices. And obviously, when just 2-3 days back, when Franklin Templeton made this announcement about marking it down to zero, everything went into a tailspin. But that has still not happened with Bharti. And in fact, if you see Bharti operationally, or if you see Bharti as a stock, I think it's performed brilliantly. So I feel that the sentiment with Bharti is a little bit more positive, although it could face a turbulent period if the AGR comes through. So that is the concern, if that is what you have. Now, coming to ultra short and the liquid part of it, obviously the tenure of the paper also is a big factor out here. So if in ultra short duration, the tenure of the paper which of the respective companies, if they are holding, will be of a very shorter duration, vis-a-vis a credit risk or a medium term fund where other hits have taken, or even FMPs are there where hits have been taken, the duration is longer. So the ultra short, although Franklin has some exposure to ultra short funds also, which is very surprising and alarming, I would say. But even earlier papers, I would not like to name them, took a hit in the ultra short category, and no one was expecting it. So coming back to the basics, do your little bit of due diligence and homework independently. And whenever you are investing in ultra short or liquid type of an instrument, do not go for any type of higher concentration of paper in a particular scheme, or even do not go for ones which are ratings are a bit haywire.
Okay, Indrajit, I hope this has helped you clear your doubts with respect to what's going on currently for debt mutual funds, especially with telecom companies finding themselves in a bit of a soup at this juncture. Okay, well, on that note, we have no more time, so we have to shut shop on this edition of Ask the Money Show. Kalpesh, thanks so much for joining us and very patiently explaining us this entire Vodafone Idea fiasco. With that, we'll take a very short break. Do come right back. We'll be back with lots more money-related news and updates for you.